Learn how choosing the right account can help your dividends grow faster and keep more of your passive income working for you. Welcome back to the channel, where we make passive income simple. Today, we're breaking down tax-efficient accounts for dividend investors. If you want your dividends to go further, or you're just starting to build your portfolio, understanding where you hold your investments can make a huge difference over time. Let's dive in. First, let's talk about why this matters. When you earn dividends from stocks or funds, it feels great to see that cash hit your account. But taxes can quickly eat into those earnings, sometimes taking away a bigger slice than you realize. Over years or decades, even a small difference in taxes can mean thousands of dollars more in your pocket just by choosing the right account. So what's the best way to keep more of your dividends working for you? It comes down to using tax-efficient accounts. There are a few main types of accounts to consider. In this video, we'll look at taxable brokerage accounts, tax-advantaged retirement accounts like IRAs, and 401 KAs, and for those in Canada, TFSAs and RRSPs. We'll cover how each one works with dividends, give simple examples, and explain key terms along the way. Let's start with the basics. First, the taxable brokerage account. This is the most common and straightforward type of investment account. You can buy and sell stocks, ETFs, or funds freely. Any dividends you receive are yours to keep, but they're also taxable in the year you receive them. For example, let's say you own 100 shares of a company that pays a $1 annual dividend per share. That's $100 per year in dividends. If you're in the 15% tax bracket for qualified dividends, you'll pay $15 in taxes that year, leaving you with $85. If the dividends aren't qualified, which happens with certain stocks or international companies, you might pay as much as your regular income tax rate, which could be higher. The key takeaway: in a taxable account, you owe tax on dividends every year, even if you reinvest them. Now, let's talk about tax-advantaged retirement accounts. In the United States, the two most common are the traditional IRA and the Roth IRA. There's also the 401k and its cousin, the Roth 401k. In a traditional IRA or 401k, you contribute pre-tax money. Your investments grow tax-deferred. That means you don't pay any taxes on dividends or capital gains while the money stays in the account. When you retire and start taking withdrawals, you pay ordinary income tax on everything you take out, both your original contributions and any growth or dividends. Here's an example. Let's say you invest $10,000 in dividend stocks inside your traditional IRA, and they pay $500 in dividends each year. You don't pay any tax on those dividends as they're earned. Over 20 years, that can add up. If you reinvest those dividends, your portfolio can grow much faster than if you were paying taxes along the way. When you start withdrawals in retirement, you'll pay tax then, potentially at a lower rate if your income is less. Now, let's look at the Roth IRA and Roth 401k. These accounts are funded with after-tax dollars, meaning you pay tax on your income before you contribute. The magic happens after that. All your money, including any dividends, grows tax-free. When you withdraw in retirement, you pay no tax at all on qualified withdrawals. Let's go back to the earlier example. If you put the same $10,000 into a Roth IRA and it generates $500 in dividends each year, you pay zero tax on those dividends, both now and in the future. That's powerful for long-term compounding. The catch is, you need to follow certain rules for withdrawals, like being age 59 and a half and having the account open for at least 5 years. If you're in Canada, the main tax-advantaged accounts are the TFSA, tax-free savings account, and the RRSP, Registered Retirement Savings Plan. A TFSA is similar to the Roth IRA. You contribute after-tax money, but everything inside grows tax-free, including dividends, capital gains, and interest. You can withdraw money at any time, for any reason, without paying tax. It's a great place for dividend stocks, especially if you want flexibility. The RRSP is comparable to the traditional IRA. You contribute pre-tax income, investments grow tax-deferred, and you pay tax when you withdraw in retirement. Both accounts can help your dividends compound faster by shielding them from annual taxes. Now let's define a few key terms that come up often in dividend investing. First, dividend yield. This is the annual dividend payment divided by the stock's current price. For example, if a stock pays $2 per share each year and trades at $40, The yield is $2 divided by $40, or 5%. Higher yields mean more income, but they can sometimes signal higher risk. Next, payout ratio. This is the percentage of a company's earnings paid out as dividends. If a company earns $10 per share and pays $4 in dividends, the payout ratio is 40%. A lower payout ratio can mean the dividend is safer and more likely to grow over time. Finally, diversification. This means spreading your investments across different companies, sectors, or even countries. Diversification reduces risk, because if one dividend stock has trouble, others might do well and balance things out. Let's bring this all together with a simple scenario. Imagine you have $5,000 to invest in dividend stocks. If you put it in a taxable account and earn 4% in dividends each year, that's $200. If you pay 15% tax, you're left with $170. Over 20 years, reinvesting dividends and compounding, the tax drag adds up. But if you put the same $5,000 in a Roth IRA or TFSA, you keep the full $200 each year. That extra growth, year after year, can mean thousands of dollars more by retirement. So what's the best account for you? It depends on your goals, income, and where you live. For most investors, using tax-advantaged accounts for dividend investing makes a lot of sense, especially if you plan to invest for many years and want to maximize your passive income. But even if you use a taxable account, understanding how taxes work allows you to make smarter choices, like seeking out qualified dividends or balancing your investments. Let's recap. Taxes can take a big bite out of your dividend income, but choosing the right account can help you keep more of what you earn. Tax-advantaged accounts like IRAs, 401ks, TFSAs, and RRSPs allow your dividends to grow faster by deferring or eliminating taxes. Knowing simple terms like dividend yield, payout ratio, and diversification helps you build a stronger portfolio, no matter which account you use. Remember, this video is for educational purposes and is not financial advice. Always do your own research and consult a professional if you have questions about your personal situation. If you found this video helpful, please like, subscribe, and share your thoughts in the comments. What accounts do you use for dividend investing? What topics would you like to see next? Thanks for watching, and see you in the next video.